We had the financial crisis with the Lehman Brothers bankruptcy, as you know, 10 years ago. Over this time period, the central banks created a GDP at $21 trillion, the major four central banks, which is equivalent to the entire United States GDP. The only issue there is there's no offsetting liabilities, costs of doing business. So it really was worth around $100 trillion on an equivalent basis. And interest rates have been low, which has been one of the main reasons that the economy continued to grow and get out of the recession. And what strikes me now, Becky, as I said in the notes that you referenced, we have the Congress and the President doing everything they can to grow the economy, the tax cuts and jobs bill. And we have the Fed with this continual, in my opinion, idiotic desire to raise interest rates to get back to some kind of normalcy that never existed, which is trying to slow the economy. So you've got parts of our own government in total conflict with each other.
Although, Mark, I understand your point that why are you moving against each other, but isn't it also great cover for the Fed to go ahead and finally get rates back to some sort of a normalized level and maybe not have it hurt the economy that badly because you've got this fiscal stimulus that's happening at the same time? I mean, when else would you raise rates?
Well, Becky, you can raise rates to some extent slowly over a period of time, but they are raising them and raising them and raising them without any let up, and they keep saying another raise in December, more raises coming up.
Yeah, but we're at 3.25% on the 10-year. It's historically speaking incredibly low.
Well, that's historically speaking, but we didn't go through this kind of crisis, probably until we went back to the Depression. And what we've also, I think, seen is lower interest rates help stimulate the economy. I think any economist in the United States would tell you that higher interest rates slow the economy. So what is the point? Just to return to some kind of normalcy that hasn't existed in 10 years? You can't go back to what wasn't.
There have been a lot of different opinions out there. Last week, we talked a little bit about the idea that maybe they should run the balance sheet off first and get rid of that stimulus before you really raise rates. What do you think of that idea?
I think that's a much more prudent way of handling it. I just think this raising of interest rates at the velocity that they're raising the rates is causing a big problem. I think it's going to play out negatively in the equity markets. I think it's going to be bad for earnings. Obviously, the prime rate goes up, home equity loans go up, cost of borrowings for corporations and people go up, cost of credit cards go up. It just is doing nothing positive to help the economy grow.
When do you think this actually has a big impact on the stock market?
I think we just got the swack on the top of the head. I think people just realized that the Fed was doing this, was going to keep doing this, and I think a lot of people decided this was going to have a negative impact finally on equities, and we're seeing the result of that in the last week or so in terms of the equity markets.